So sales on a bank credit card. On July 15th, we have credit card sales related to a bank credit card that has the 4% fee. So let's say Visa. What is the entry? So in this case, since it's no longer our credit card, it's not the target credit card, it's a bank credit card or an issuer credit card, we're going to have a credit expense for the fee, the 4% fee, and then we have our sale of 100. So the sale never changes. We have cash, which is 96, and a credit card expense of 4. We omit the entry for debit cost of sales and credit merchandise inventory to focus on the credit card expense. So the credit card expense itself will then be a reduction to your revenue. It's going to be a contra revenue account. So to reiterate, right? Again, so far we've talked about accounts receivable. We've talked about what the different types, why we would have accounts receivable, and the different ways we can do it. We can have accounts receivable through sales on credit, where we just invoice a customer and say they can pay us in the future, which was this TechCom example. Then we can have our sales on store-owned credit. That was our example with Target. If Target issues a credit card that they own, they can collect interest revenue on it, but the risk there is that they are taking the credit risk. Or we can have a bank credit card. So the bank credit card, the advantage is we don't have credit risk anymore, but we have to pay a fee to the credit card company. And then you will be required to know these different transactions and the journal entries related to them.